Hi everyone, welcome back to my channel. In this video, I'm going to be sharing about my core Australian stock holdings and share a little bit about them and why I chose to invest in them to generate a stable dividend income in a tax-friendly way. Now again, this is not investment advice. I'm just sharing my passion for researching companies and my own personal investing strategy. Everyone's situation is different, so make your own decisions based on your own situation, not mine, and do your own research as well. So investing in ASX companies is part of my overall income investing strategy in stocks, which you can actually learn more about in some of my other videos. But it's due to a couple of things. First being that I'm not only personally familiar with Australia, obviously, but the ASX companies have a very large focus on paying dividends to its shareholders. So the overall yields in the Australian market are really good compared to some of the other countries. The second thing is due to this thing called franking credits. So a quick explanation of what this means. Basically, dividends are actually paid out of profits which have already been subjected to the Australian company tax rate of 30%. So this basically means that shareholders receive a rebate for the tax that have already been paid by the company on those profits distributed as dividends. So if I was still at home in Australia, I would receive a credit in my tax return for the tax that the company has already paid, which is great. But living in Singapore, it basically means that there is no withholding tax on the company dividends that are paid, and they're paid across to my Singapore brokerage account in full. And the same would apply for any expat investor or Singaporean invested in the ASX stocks from Singapore that pay of this fully franked dividend. I decided to invest in listed investment companies. So the job of a LIC is basically to invest in other assets on basically your behalf. So I think listed investment companies is a great alternative for Singapore investors to actually get exposure to the Australian share market, which is larger and actually has a very long history of stable returns, and actually be entitled to the full dividend that these companies pay due to the franking system that I just shared as well. So rather than invest in an ETF or choosing specific dividend paying companies, LICs are a good option to be exposed to ASX dividend shares because they can turn investment returns, including capital growth, into a really consistent dividend income for their shareholders basically. So the two ASX listed investment companies that I have invested in for income are Milton Corporation and Wam Microcap. So I decided to invest in each for diversification across the ASX for both large and small cap stocks, and due to also the fully franked dividend that they both pay out, I wanted to get a stable income and leave the investing decisions to more reputable firms that have a good track record and investment mandates that are also aligned with my own personal investing strategy. So all I really wanted from these investments was to generate a stable growing income over time without actually having to worry about individual company performances and making those decisions myself. So this being said, let's take a look at them and let me share a little bit why I like them and some of the stocks that each of these listed investment companies hold. So the first stock is Milton Corporation, ticker symbol MLT. So Milton has been an investment company since 1938, and it became a listed investment company when it was listed on the Sydney Stock Exchange back in 1958. So Milton is known as one of the old guards of LICs in Australia, and they're also known for their conservative and steady investment approach as well, which was part of their appeal. So if you invested $10,000 in Milton back in 2000, and if the dividends were also reinvested over the 20 years, the value of the investment in 2020 in June would actually be worth over $54,000. And the total shareholder return for the past 20 years, this works out to be about 8.9% per annum. So let me run through a few of the key reasons why I invested in Milton Corp. So the first is their disciplined investment process. They have this investment philosophy that is predominantly as a long-term investor in companies and trusts listed on the ASX that are very well managed with a profitable history as well as an expectation of increasing dividends and distributions, which is what I want, right? Milton also has three key objectives. One being increasing their fully franked dividend paying out to shareholders over time. Two being providing capital growth in the value of shareholders' investments. And three being investing in a diversified portfolio of assets, which are predominantly Australian listed companies and trusts. All three of these basically sum up exactly why I invested in them. So they have a very diversified portfolio of investments in ASX listed companies. So the income and growth that they obtain is not only reliant on just one company's performance, but a whole broad range of companies that they invest in. You can see here the broad sectors of their portfolio is made up, which is spread across financials, industrials, through to healthcare and consumer staples. Their largest holdings currently are Commonwealth Bank and Macquarie Bank, BHP and Washington Soul Patts. So you can see that they have a focus on very large blue chip companies that pay fully franked dividends. So every LIC, you have to pay management fees to the team managing the companies and executing their investment plan. So Milton's fees was only about 0.14% per annum, which is one of the lowest in the industry. So another is obviously their fully franked dividends, which are considered quite reliable. So in terms of their dividend track record, they have increased their annual dividends per share every year since the global financial crisis. So as I shared earlier, fully franked dividends are an important tax-effective component of an investor's return. So Milton actually aims to pay out between 85 and 90% of their underlying profits every year as ordinary dividends, and also pass on to shareholders the fully franked special dividends that they accumulate from the companies that they've invested in. Transparency is another one. So every month, Milton reports its net asset backing, so their top 20 holdings and asset allocation by sector on the ASX, and their profit reports are provided to the ASX on a semi-annual basis as well. So every month, you can actually see an update of what they're holding, their net tangible assets, price, and also all the investment holdings at the same time as well. So if you take a look at the current stock price, Milton is currently trading at $4.17 per share. Milton's latest net tangible asset price announcement, the net tangible asset price was at $4.29. So currently the stock price was actually below their net tangible asset price as well. So you're kind of buying $4.29 worth of assets at $4.17 per share. The dividend yield at its current share price is currently sitting at just over 4%. Fully franked. So while Milton's holdings are concentrated on larger cap blue chip kind of companies, I also wanted exposure to smaller cap stocks while also generating an income from them at the same time. But what I found over time that researching smaller companies are actually quite a lot harder because they are not as covered as much by analysts. There's not as much online about them. I decided to look into investment firms to actually do this for me. So usually small cap stocks are more volatile and a little bit more riskier, but smaller companies can also offer a lot more larger long-term growth as well. So in theory, obviously a smaller company actually has more room to grow. So when it actually came to deciding how to invest in them, I choose Wam Microcap, ticker symbol WMI, to actually help me invest in this sector of the market while at the same time generating some good dividend yields too. So Wam is actually a listed investment company run by Wilson Asset Management, which run a number of different LICs and have been operating since 1997. So Wam run a number of different LICs, but I chose to invest in Wam Microcap as it's their listed investment company that invests in small cap ASX shares. So they basically invest in companies that have market caps under $300 million, and the company's investments objectives are to A, deliver a fully franked dividend, B, provide a capital growth over a medium term, long term, and C, preserve shareholders' capital. So Wam Microcap's investment process essentially involves diligent and deep research that focuses on the company's cash flow, return on equity, and basically the quality of the company. Each company is actually very carefully rated in respect to the management as well as earnings growth potential, valuation, and their position in the industries as well. So their portfolio is actually spread across a number of different industries, allowing basically a diversification of different types of small cap stocks, but focus mainly on sort of consumer discretionary and IT, where obviously a lot of growth companies exist. So you can see in the industry concentration is actually quite different to that of Milton's example, which I shared earlier, which basically gives me diversification across those two listed investment companies that I've invested in. And here are some of their biggest two small cap holdings of the last month with significant contributions to their portfolio outperformance, being Marley Spoon, ticker symbol MMM. They're basically a subscription-based recipe and meal kit provider, and a software solution company called Milton Corporation, ticker symbol OCL. So if you take a look at Wam Microcap, the current share price is $1.48 per share. Latest net tangible asset announcement last month was $1.38 of assets per share. So during the recent pandemic, the stock actually had quite a big sell-off and dropped well below its book value. But since then, it's actually recovered and has actually shown a return of 15.9% per annum. So it has been a really strong performing listed investment company, and it has funded a very solid dividend, which last year paid out 9 cents last year. So based on the current share price at the moment, it's actually yielding about 6%. So basically, those are my two core ASX stocks that I hold to generate dividend income generated from the Australian market. I decided not to invest in multiple companies and only these two, but through these two listed investment companies, I'm indirectly invested in a lot of blue chip companies and small cap stocks in Australia. So I added both to both during the recent pandemic downturn, and obviously now I wish that I invested a lot more in March and April when both of these stocks really dropped quite a lot below their net asset value on their books. But I also have a long-term investment horizon for both of these companies, and I plan to average in on a regular basis moving forward, and will certainly invest more when there's another market-wide downturn in the future as well. So as always, if you're interested to learn more about personal finance or see more about my own stock investment portfolio and strategy, check out my channel and subscribe, because I release videos every week to share more about my own investment journey, and anything else that you guys want me to talk about, just let me know in the comments section. So until next time, bye.